Hello everyone, today we're jumping into a topic that has completely transformed the way people build wealth all around the world, and that is dividend investing. Dividend investing is one of the most powerful, reliable, and exciting long-term strategies out there, and today I'm breaking it all down for you. We're going to talk about how dividends work, why some companies pay them, and how you can start collecting them, even if you're starting with just a small amount of money. Create a dividend portfolio that grows automatically through smart investing. Smash that like button, hit subscribe, and let's dive into the good stuff. Quick disclaimer. I'm not a financial advisor, and this video is for educational and entertainment purposes only. Any investing decisions you make are entirely your responsibility. Always do your own research. The first thing you need to know is that when you're young, time is on your side. You've got time to ride out market ups and downs, so young investors can dive into those high-growth, more volatile stocks. But as you get older, your priorities change. You start wanting stability instead of big swings, and you want your portfolio to generate consistent income. That's where dividend-paying companies come in. Dividend stocks pay you regularly, quarter after quarter, and many of the best ones increase their payouts every year. They are less volatile, more predictable, and they help protect your wealth as you approach retirement or financial independence. In simple terms, when you're young, you build the machine, and when you're older, the machine pays you. Investing monthly is one of the most powerful habits you can build, because it removes emotion, removes guesswork, and replaces hope with consistency. The truth is, nobody can predict the perfect moment to buy. Markets go up, markets go down, and if you wait for the best price, you usually end up waiting forever. But when you invest every single month, no matter what the market is doing, you automatically average your cost over time. This strategy is called dollar cost averaging, and it protects you from buying too high or waiting too long. Some months you buy when prices are up, some months you buy when prices are down. But over time, your average cost becomes steady, and that consistency is what builds wealth. Monthly investing also helps you stay disciplined. It turns investing into a routine, like paying a bill to your future self. You don't have to overthink it. You don't have to panic when the market dips. You simply follow your plan, and eventually that habit becomes one of the strongest advantages you have. Another reason is that it keeps you investing during down markets, and that's when the best opportunities appear. When prices drop, those same monthly contributions suddenly buy you more shares. More shares mean more dividends, and more dividends mean faster growth. It's not about timing the market. It's about time in the market, and monthly investing keeps you in the game. You don't need to be perfect. You just need to be consistent. And consistency over the long run beats almost everything else. Another key factor that accelerates your long-term growth is the simple habit of reinvesting your dividends. Instead of taking the cash out and spending it, you use it to buy more shares. At first, the difference seems small, but over the years, those reinvested dividends start to snowball. The effect compounds and your portfolio begins to grow, not just from your monthly contributions, but from the income the investments generate on their own. Reinvesting doesn't require timing, luck, or financial genius. It only requires patience and discipline. The longer you stay invested, the stronger compounding becomes. Every year, your gains have the chance to generate more gains. Time is what transforms consistency into real wealth. Also, dollar cost averaging simply means investing the same amount of money at regular intervals every week or month, no matter what the market is doing. You're not trying to predict the highs or the lows. You're just investing consistently. Over time, this creates a smoother average cost for your investments. It protects you from emotional decisions and takes away the pressure of trying to time the market. Take note that many of the market's biggest recoveries happen right after the sharpest drops. If you stop investing during those moments of fear, you miss out on the strongest rebounds. But if you stay consistent, your regular contributions turn those lower prices into an opportunity instead of a threat. Another key part is building enough knowledge about the stock market so you don't panic sell every time things turn red. Panic usually happens when you don't understand what's going on. When someone knows very little about how the market works, even a normal downturn can feel like a disaster. But the more you learn, the more you realize that volatility isn't unusual, it's completely normal. Knowledge teaches you that corrections, dips, and big crashes have always been part of the market, and yet the market has always recovered and gone higher over time. The best way to build that knowledge is to actually educate yourself. There are so many accessible ways to learn today. You can watch YouTube channels that explain investing in simple terms. You can read beginner-friendly books that break down market cycles, company fundamentals, and long-term strategies. You can follow experienced investors, listen to podcasts, and even use investing apps that show real data in a clear way. Knowledge turns fear into patience. It teaches you that the worst time to sell is usually when you feel the most afraid. Learning about investing doesn't just make you smarter, it makes you calmer. And that calmness is what keeps you invested long enough to actually see the long-term rewards. Another principle that can make investing much easier and far less stressful is to invest in what you love, what you know, or what you personally use. When you understand a company in your everyday life, it becomes so much easier to stay confident during market ups and downs. When you understand how a business works, how it makes money, and why people keep buying from it, you don't get scared when the stock price dips. And sometimes it's simply about the yield. Some investors choose a company because it pays a dividend that fits their goals. Maybe it's a high yield for income or a stable yield from a trusted business. There's nothing wrong with loving a company for the steady cash flow it provides. And when it comes to dividend investing, one of the first numbers people look at is the dividend yield. The yield tells you how much cash the company pays you every year compared to the price of the stock. It's basically your income rate. If a stock costs $100 and pays $4 a year in dividends, that's a 4% yield. Simple, clear, and easy to understand. Dividend yield matters because it shows the quick cash you get just for owning the stock. A higher yield means more income, which is awesome if you want to boost your cash flow. But remember, yield isn't everything you should check out. A very high yield can look tempting, but sometimes it's high for the wrong reason. Maybe the stock price crashed because the company is struggling and the dividend is at risk. That's why the best approach is to balance yield with safety. A solid yield in the 2 to 6% range from a healthy company can be far more valuable in the long run than chasing something that looks too good to be true. Good dividend companies raise their payouts over time, which means your yield on cost grows as well. The goal isn't just to chase the highest number, it's to find companies that pay well, grow steadily, and reward you for the long term. A low yield doesn't always mean a stock is bad. Sometimes it simply means the company chooses to reinvest earnings back into the business to fuel growth. And a high yield doesn't always mean a company is generous. Sometimes it means the market is warning you. The stock price might have dropped for a reason. The business might be slowing down. The dividend could be at risk of being cut. Dividend yield also changes with the market. When prices fall, yields rise. When prices rise, yields fall. And this creates opportunities for long-term investors. If you stay calm during downturns, you can lock in higher yields on great companies simply because the market is temporarily scared. Those are the moments when disciplined investors get rewarded. Another important factor to look at when evaluating a dividend company is its dividend payment history. This is one of the simplest and most reliable signals of how a company treats its shareholders. A strong history shows consistency and a long-term commitment to returning value. When a company has been paying dividends for many years or even decades, it tells you something meaningful about its business. It means the company has stable cash flow, predictable earnings, and enough financial strength to share profits regularly. Even more impressive are companies that not only pay dividends, but increase them year after year. These are usually the companies with solid fundamentals, strong management, and a clear focus on long-term growth. A long, clean dividend history is also incredibly helpful during volatile markets. When prices drop and investors panic, the dividend payment record becomes a source of confidence. If a company has been paying dividends through recessions, crashes, and market chaos, you know it has the resilience to survive tough times. You also learn a lot by looking for dividend cuts. If a company has a history of cutting or eliminating its dividend, that can be a red flag. A cut usually means the business is under pressure or the cash flow isn't enough to support the payout. Dividend history also ties directly into your long-term returns. The longer a company raises its dividend, the faster your income grows, and if you're reinvesting those dividends, a long history of increases can dramatically accelerate your compounding. Once you start paying attention to dividend history, you'll quickly notice that dividend-paying companies often fall into certain categories. One of the most well-known categories is the dividend aristocrats. These are companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. A quarter of a century of raising dividends, that's strength, discipline, and long-term commitment. Aristocrats are often stable, mature businesses that can weather economic storms and still reward shareholders. Then you have an even more elite group, the dividend kings. These companies have raised their dividends for 50 years or more, half a century of increases. That means they've survived recessions, inflation spikes, market crashes, wars, and technological changes. And through all of it, they continued to grow their dividend. Owning a dividend king is like owning a piece of a company that has proven its resilience across multiple generations. There are also dividend achievers, which are companies that have increased their dividends for 10 consecutive years. These may not be as well known as aristocrats or kings, but they can be incredible opportunities, especially when they're in the early stages of building long dividend streaks. You'll even find companies called high-yield dividend payers. Companies that might not have long histories of increases, but they offer higher yields today. These can fit into an income strategy, but they require more caution and research because high yield often comes with higher risk. And then there are growth dividend companies, businesses that may have lower yield today but grow their dividend at a much faster rate each year. These companies can be powerful in the long run. Understanding these categories helps you build a more balanced dividend portfolio. You can combine stability from the kings and aristocrats, growth from faster increasing companies, and carefully chosen higher yield picks when they fit your risk tolerance. Managing your portfolio is just as important as choosing the right companies. Even the strongest dividend stock can face challenges, so having a balanced approach protects you and keeps your long-term plan stable. And the core of strong portfolio management is diversification. It's ideal to split your investments across different sectors, industries, and types of companies. Diversification doesn't mean owning everything you see. It means building a collection of businesses that don't all move the same way at the same time. When one sector struggles, another might be performing well. When one company cuts its dividend, another might be increasing theirs. Managing your portfolio also means regularly checking the fundamentals. You don't need to watch prices every day. It also helps to rebalance. Occasionally, if one stock grows a lot and becomes a huge part of your portfolio, you might reduce it slightly to maintain balance. If another stock drops but the fundamentals remain strong, you might add more at a better price. Specifically, I like to maintain roughly 10% of my portfolio value as cash on hand. Why? Because markets move quickly. Great companies can suddenly dip in price, and opportunities often show up when most investors aren't prepared. By having that 10% available, I give myself the flexibility to act with confidence instead of hesitation. And to make all of this easier, it really helps to use the right tools. You don't need to do everything manually or track your dividends with spreadsheets unless you want to. There are platforms designed specifically to make dividend investing simpler, clearer, and more organized. Using them can save you a lot of time and stress. One of the tools I personally like is Simply Safe Dividends. It's a platform made for dividend investors, and its main strength is showing you how safe a company's dividend really is. It gives you safety scores, payout ratios, cash flow insights, dividend history, and alerts if something changes. Instead of guessing whether a dividend is safe, you get a clear data-backed picture. It's great for researching companies, finding new dividend stocks, and keeping track of the ones you already own. Also, if you're an iOS user, another tool I personally use and enjoy is the Dividend Tracker app. It's simple and made specifically for tracking your dividend income. You can input your stocks, and the app shows your monthly income, yearly projections, upcoming payments, and yield on cost. These tools don't replace your own research, but they support it. They help you stay organized and informed. And as you explore dividend investing, you'll eventually come across different types of investments beyond regular companies like REITs and dividend ETFs. These are two powerful tools that can add diversification and extra income to your portfolio, and understanding how they work can help you decide if they fit your strategy. REITs or real estate investment trusts are companies that own or operate income-producing real estate. Instead of you buying a rental property, dealing with tenants, and managing repairs, a REIT does all the work and pays you a share of the income. By law, REITs must distribute at least 90% of their taxable income to shareholders, which is why they often offer higher dividend yields than regular stocks. There are different types of REITs. Some invest in apartments, some in office buildings, some in warehouses, data centers, hospitals, or even shopping malls. What makes them special is that they give you exposure to real estate without needing to buy physical property, and they can add stability to your portfolio. Dividend ETFs distribute dividends they collect from all the companies inside the fund, and they pay them out to you usually monthly or quarterly. They tend to be more stable than individual stocks, because one company's bad year won't drag down the entire fund. Another part of dividend investing that you need to understand is the impact of costs and taxes. These might not be as exciting as dividend yield or compounding, but they can have a big effect on your long-term results. First, let's talk about costs. Every investment comes with some kind of cost, whether you see it or not. Some brokers charge trading fees, some ETFs have expense ratios, and some platforms charge subscription fees. Even if these costs seem small, they add up over time. Then there's the subject most people avoid, and that is taxes. Dividends are usually taxed, and depending on where you live, the rate can vary. Taxes reduce the amount of income you actually receive, so it's important to understand how your country taxes dividends and capital gains. For example, some countries have withholding taxes on dividends from foreign companies. Others tax your dividends as income. Understanding your tax situation helps you make smarter decisions. You might choose certain ETFs because they are tax efficient. You might keep high-yield investments in accounts with lower taxes. You might decide to reinvest dividends instead of taking them out because reinvesting can reduce the immediate tax impact. When you start investing in dividend-paying companies, another useful part of your analysis is understanding the key dividend dates. These dates tell you when you'll receive dividends, who qualifies to receive them, and how to plan your cash flow. Knowing these terms makes you a more organized and more confident dividend investor. The first date to pay attention to is the ex-dividend date. This is the most important one. The ex-dividend date is the cutoff. If you want to receive the next dividend, you must own the stock before this date. If you buy the stock on or after the ex-dividend date, you won't get the upcoming payment. It simply goes to the shareholder who owned it the day before. This is why many dividend investors track ex-dividend dates closely. It helps them plan their purchases and avoid missing a payment. Next, there is the record date. This is the day the company checks its official list of shareholders. If your name is on that list by the record date, you're entitled to receive the dividend. You don't have to do anything for this. If you own the stock before the ex-dividend date, you will be on the record list automatically. Then you have the pay date, also called the payment date. This is the day the dividend actually arrives in your account. On this day, your broker deposits the money from the company directly into your portfolio. Dividend investors live for this moment, seeing that income roll in, reinvesting it, and watching their wealth snowball. Different companies have different schedules. Some pay quarterly, monthly, or even annually. You can find all this with just a search on Google. Understanding these dates helps you avoid confusion and missed opportunities. Instead of guessing when your dividends will arrive, you know exactly how the process works. At the end of the day, dividend investing isn't about being perfect. It's not about predicting the market or chasing every trend. It's about building a strong foundation, learning the basics, staying consistent and trusting the process. The more you understand the companies you invest in, the more confident you become. The more tools you use, the more organized and informed you feel. Also, the more disciplined you are with reinvesting dividends, the more your portfolio will grow over time. Because the real power of dividend investing isn't in what happens today or tomorrow. It's in what happens over years and decades. Stay patient, stay consistent, keep learning, and let compounding do the heavy lifting. Invest, forget, and let time build the future you're working for. That concludes our overview of dividend investing and the principles that make it such a powerful long-term strategy. The goal isn't to chase quick wins or predict short-term market movements. The goal is to develop a disciplined approach, stay committed to your plan, and allow compounding to work in your favor. If you found this information helpful, consider liking the video and subscribing to the channel for more content focused on investing. And feel free to leave a comment below with your own experiences or questions regarding dividend investing. Thank you for watching. Maintain your consistency, stay informed, and I'll see you in the next video.